Chapter 15, long-term liabilities. Okay, so bonds are basically the other major way for a corporation to generate capital in addition to issuing stocks. Now, compared to stocks, the relative advantages of issuing bonds are ownership or stockholder control is not affected by bonds. The interest paid on bonds is deductible, so it can be a tax benefit. And when you look at your analysis, earnings per share and various other categories of analysis may end up looking better through bonds. Now there's several different kinds of bonds. We've got secured versus unsecured, and with unsecured, a synonym of that would be debenture or debenture bonds. These are generally, the secured ones are secured by real estate or various other types of assets. Basically anything that has value that can put the mind of the person buying the bonds at ease, knowing that if the company defaults, they can have this property instead. We've got term versus serial bonds, and term just means that the entire principal is paid at the end of the period, and serial bonds, you pay principal and interest payments ongoing throughout the term of the bond. Convertible and callable bonds. Convertible bonds allow the bondholder to convert them to common stock at their leisure. So this basically is an advantage to those, because if common stock ends up being more valuable than the bonds, then they have the option of switching. So these are generally issued for a lower interest rate because there are some perks to having these kinds of bonds. So someone should, or the company should have to pay less interest on these when they issue them, because they're giving, in addition to cash and interest payments, the option of the bondholders increasing their gains by the stock going up. And then you have callable bonds, which just means that the person or entity who's issued the bonds is able to buy them back before they are due, usually at some maybe higher rate than is bargained for on the face value of the bonds. So to be able to issue bonds, generally the board of directors and stockholders have to approve the issue. The board of directors stipulates a lot of the specifics of the bonds, all the terms, all the legalese that goes into the bonds, that sets everything out in stone, is set out in the bond indenture, which is kind of the legal contract. And then generally issues of bonds are handled by a middleman or a trustee who records all bondholders and holds conditional title to any pledged property, so that if the company defaults on the bonds, the trustee can just sign over whatever pledged property to the bondholders. So if a bond pays no interest, it's called a zero interest bond. If something pays out $1 million in 10 years, it's unlikely that we're going to pay $1 million for it right now, because that's essentially loaning $1 million out for 10 years and getting nothing back other than your money. So that would be something that very few people would want to do because of the time value of money. Generally, there's something that you can do with that money that will cause it to earn more money. So why would you tie it up and not have it earn anything over that amount of time? So generally, when you're looking at investments and you're looking at, okay, what's in my best interest? If I'm going to get $1 million back in 10 years, how much would it be worth to me right now to get $1 million in 10 years? In other words, what kind of return do I want on my money, so that, if I invest, say, $800,000 right now and get $1 million back in 10 years, that's a 25% gain on my money. Is that something that is worth it to me? Okay, so when you look at how much, something in the future is worth to you now, that's called turning or flipping it to give you the present value. Okay, so the value right now of something that you're going to get in the future. So when you're determining the market value of bonds, there's 3 things you need to factor in. The dollar amounts to be received at maturity, so how much money are you going to get in the future? How long in the future is that going to be? And what is the market rate of interest? In other words, if I was going to invest it somewhere else, how much money would I be getting back in 10 years or however long the time period is. Okay, so when a company issues bonds or sells them, you have to do accounting on that. When the company buys them back or retires them or redeems them, you need to do accounting entries at that point. So when bonds are issued, they're issued either at face value, above, which is called at a premium, or below face value, which is called a discount. So usually each bond is worth $1,000 and the price is listed in a percentage. So if you have a bond that's worth $1,000, the face value is $1,000, but it's only selling for $950, then it would be quoted as a quoted price of 95 or 95% of that 1,000. So that would be at a discount. If it's selling at 105, that would be 105, or I'm sorry, let me back up here. So 950 if it's at 95, and then 1050 if it's at 105. Okay, so you're basically just going to turn whatever the quoted number is into a percentage and multiply that percentage times 1,000. So, example here, the accounting for issuing a bond at face value. So the bond is a $100,000 10-year 5% bond, and it's issued at 100, which means it's just face value. Okay, so the initial entry is going to be you getting $100,000 cash, and you're going to record a liability for bonds payable of $100,000 that you're going to have to pay back in the future. Okay, and this will be a long-term liability because it's not going to be due within the next year. So if interest on that bond is paid semi-annually, then you would take the $100,000 principal and multiply it times 5%, which would give you $5,000. And if it's paid semi-annually, you would divide that by 2. Okay, so you're going to have $2,500. So each time you paid those semi-annual payments, you would have an interest expense debit of $2,500 and a credit to cash for $2,500. Okay, so at the end of the year, let's assume that interest is due on January 1st, but the year ends on December 31st. So basically the entire 6-month period has gone by. You know you owe that whole $2,500, but you're not going to pay it till tomorrow. And we have to close the books today for this year. So we need to record the full amount of that interest expense that has accrued over the last 6 months and record the fact that we're not going to pay it today. Okay, so we're going to debit interest expense for $2,500 just like we would if we were going to pay it, but instead of crediting cash, we're going to credit interest payable to show that we're paying it in the future, even though it's just going to be tomorrow. Okay, and then tomorrow when we actually pay it, we're going to eliminate that payable, so we're going to debit instead of crediting. We're going to debit interest payable for $2,500, and then we'll credit the cash for $2,500. So bonds are only going to sell at face value when the market rate and the contract rate are the same. So if you have your bonds say that they're 5% bonds, if the market rate, or in other words, what you could get in interest from some other investment in the market is more than 5%, then of course you're not going to invest in bonds that pay less than the market rate. Okay, so depending on what that market rate is compared to the contract rate determines if it's going to be sold at a premium or a discount. The actual rate on the bond doesn't change. What changes is the amount of money loaned to get a payoff of $1,000 at maturity for each bond. So we're still paying, if it's a 5% bond, we're still paying 5% interest on that $1,000 bond. Okay, but instead of them loaning us $1,000 to get that money, to get $1,000 back in however many years plus the interest, they're going to pay us either more or less than $1,000 up front, depending on whether they're buying at a premium or a discount. Okay, so let's assume they're buying at a discount. $100,000 worth of bonds sold at 97%. Excuse me. They are 10-year 5% bonds. This is the entry for the initial sale. So that means we're only getting $97,000 in cash up front, and we're still going to pay $100,000 in the future. So debit to cash $97,000, credit to bonds payable for $100,000, okay, And then the difference there is going to be the discount on bonds payable, okay, to make up that difference between 97,000 and 100,000. And again, like I said before, the discount or the premium on bonds payable, the amount in that account goes up or down. So for a discount, that amount, the discount is going to go down, the amount that we have in that account, as time passes. So then when the bond is about to be totally paid off, the discount will be totally gone. Okay, so that's basically just a way to, instead of recording that as us getting $3,000 less right now, what we're kind of doing is incorporating that $3,000 into the interest payments. Okay, so that's issuing bonds at a discount. Issuing bonds at a premium. Let's assume again we have a $100,000 5-year 10% bonds, and they're issued for 106.5. The entry to record the issuance shows cash going up, so we're getting 106,500 in cash. And then we are still paying $100,000 back in the future, so credit to bonds payable for $100,000. And now instead of there being a discount on bonds, we have a premium on bonds payable to make up the difference between cash and bonds payable. And again, that premium on bonds payable is basically just a holding account, and over time that will go down, and that money will be transferred over to interest expense. So in this situation, it would be lowering as time passes. Interest expense would get lower and lower because we'd take money out of that $6,500 premium, and as time passes, that money would go over and reduce interest expense, so that basically at the end of the 5-year period, we would show in our interest expense less than 10% interest over that time period. So basically, it's just a way to change the percentage of interest that we're paying without having to change the percentage that shows on the face value of the bonds. Okay, but in practicality, all you really need to know is, the question statement here shows you how much cash you're going to have to get or pay. Shows you how much cash you're getting, whether it be higher or lower. And then we also know that, when you're crediting bonds payable, that's always the face value of the bonds. And then all you have to do on your own is make up the difference. So if you're getting more cash than the bonds payable, then you show a premium. If you're getting less cash than the bonds payable, you show a discount. Okay, so if we want to calculate the total cost of borrowing, let's assume we have a sale of 100,000 10-year 5% bond sold at 98. So we're going to calculate the total amount of interest payments. So we have 100,000 times 5%, which is going to be 5,000. That's how much we're paying each year for 10 years, $50,000. Add what we are going to have to pay at the end of that 10 years, which is $100,000. So we have $150,000 that we're going to end up paying our bondholders. And what did they give us for that $150,000 that they're going to get back over time? They gave us $98,000 up front. So we subtract that out, and we see that the total cost of borrowing that money to us is going to be $52,000. So we're paying $52,000 extra, essentially, to borrow $98,000 today. Okay, that's what that means. Okay, so now let's look at retirements of bonds. So now we're just going to assume that we are retiring this bond at maturity. So that means we have a sale of $100,000 6% 10-year bonds at 98. We are going to make all of our interest payments, and at the end of that 10-year period, we're going to pay off the remaining balance of the bond. Okay? Since it's a $100,000 bond, we initially recorded a credit to bonds payable of $100,000. We turn that into a debit to get rid of it. We credit cash for that amount. The bond is done. Okay? Pretty easy for recording a bond at maturity. So if we end up retiring a bond early or buying it back before maturity, we need to know one extra piece of information. We need to know what the current carrying value of the bond is. So that basically means what amount of money do we still have in either that premium or the discount account that we recorded when we initially sold the bonds. Okay, so these bonds were initially sold at a premium, and when we're going to redeem them, the balance in that premium account is $1,526. So I just took the current carrying value and I took out, the face value of the bonds, $100,000. So that $1,526 represents the amount that's still in that premium account. So here's what it looks like. We know several pieces of information. In this journal entry, first, since we know the face value of the bonds $100,000, we know that we need to debit bonds payable for $100,000 to get rid of that liability. We also know down at the bottom that we're paying a premium of $104 to buy these back. So if we take $100,000, the face value of the bond, times 1.04 or 104%, that gives us the cash of $104,000. Okay, so now all we have to do is make up the difference of that $4,000 that we need to somehow add into the debit side. So since we know the current carrying value is $101,526, like I said, that $1,526 represents what's still in that premium on bonds payable account, which was initially a credit. So to get rid of the amount that we still have in there, we debit premium on bonds payable for $1,526, but we still have a difference between debits and credits here. So since we still have a difference on the debit side, we know that's going to be a loss because we are paying a premium to redeem these. So anytime we're paying a premium to redeem them, chances are we're going to lose money on the deal because we're paying extra money above the face value to redeem them. So we debit whatever the difference is between bonds payable, premium on bonds payable, so $101,526, and cash that we're paying, $104,000. So the difference between those is that loss on bond redemption of $2,474. Okay, so again, now we're looking at convertible bonds. So if we issued bonds and then the bondholders decide they're going to convert these into stock. Okay, so here's the situation. First of all, here's the parameters of how you do that. You ignore the market value, and remember there's no gain or loss on this transaction. You look at the carrying value of the bonds and the par value of the stock. Okay, so assume we have $100,000, 5% bonds, carrying value $103,000, and it's redeemed for 6,000 shares of $10 par value stock. Okay, so the face value of those bonds shows us what we initially had in bonds payable. When we sold those bonds to begin with, we got some money and we recorded a liability because we assumed we were going to have to pay that $100,000 back in the future. So now we're not going to have to pay that back because they're changing it into stock. So we're going to debit bonds payable for $100,000. Okay. Then we look at the carrying value. So we see $103,000. That means $3,000 is still left in the premium on bonds payable account from when we first sold these bonds. So to get rid of it, it was initially a credit balance. Okay, so to get rid of it, we're going to debit premium on bonds payable for $3,000. So that those first two debit entries, we have that information in the question. $100,000 par value, carrying value of $103,000. That gives us the first two entries. Okay, and then to show us the first credit entry of common stock there, we just write down what the par value is of that common stock. So 6,000 times $10 gives us a $60,000 par value. Okay, since the par value is $60,000, but there the bondholders are essentially giving up $103,000 to get that common stock, we know it must be worth more than $60,000. So that additional money that they're giving up to get the stock excuse me, becomes paid in capital in excess of par, That should say par down there, not pay, of $43,000. Okay. So now, moving on to long-term notes payable. This is the mortgage example that we were looking at, and basically, if you have fixed semi-annual payments of $33,231 and an interest rate of 6%, this is actually a slight mistake down here. Instead of recording the first payment, basically this is recording a full year of interest. So to record the mortgage loan, we have a debit to cash of $500,000, a credit to mortgage payable for $500,000. That just shows that we are going to owe that mortgage. Okay, we got cash and we owe them $500,000 back. The first year's worth of payment. So let's assume this is an annual payment of $33,231, interest rate 6%. So we know we're paying $33,321. We don't know how much of that's going to interest and how much is going towards the principal. To find that out, we multiply the interest rate 6% times the outstanding principal, or the total principal, since this is the first payment. $500,000, which is the principal, times 6% gives us $30,000. So that first year we're going to pay $30,000 in interest. And since we know the payment is $33,321, the remaining difference between what we pay in interest and the payment that we make is the amount that gets to go towards the principal. So we have a debit to interest expense, $30,000, credit to cash for the amount that we're paying, and the difference between those is the amount that's coming out of the mortgage payable. So that's how much we're paying down the mortgage. So to figure the next year's payments, instead of taking $500,000 times 6%, we're going to subtract that $3,231 from the principal. Okay, so that would give us $496,769, and we would multiply that times 6%. That would give us the interest expense that we owed for the second year, and whatever the difference was between that interest expense and the cash that we paid would be the amount we paid towards the principal in that second year. And you would go on and on and on until the principal was down to zero. Okay, we talked a little bit about lease liabilities. Difference between an operating and a capital lease. An operating lease is generally what you think of when you think of a lease. It's renting something for usually a somewhat short period of time, and it's pretty easy to account for. A capital lease is kind of an accounting fiction that allows. It basically is a way to recognize that most of the benefits of ownership of whatever item you're renting are going to you. So even though you don't technically own it, you still have most of the risks and rights and benefits of ownership. So for accounting purposes, we're going to assume that you kind of do own it. Okay. So for an operating lease, pretty easy. If you have a rental car for 5 days at $50 a day, you're going to debit some expense account. In this case, car rental expense for $250, credit cash. Okay, that's as far as it goes. Pretty easy to figure out. For a capital lease, first we need to determine what is a capital lease. What qualifies as a capital lease? So these are some parameters set out in the accounting world that let you know that most of the risks and benefits of ownership are being transferred to the lessee or the person leasing this property. So either lease transfers ownership of the property to the lessee, so ownership is changing hands in that case. Lease contains a bargain purchase option, so at the end of the lease, if you're able to purchase it for well below market value, or 3, lease term is equal to 75% or more of the economic life of the asset. So if you're leasing something that's only going to be useful for 10 years and you're leasing it for 8 years, we're going to assume that most of the value of that piece of property is yours. Or the present value of the lease payments is greater than or equal to the fair market value of the leased asset. So when you take all the lease payments that you're going to pay and you turn those into the current, present value of those payments, if that's more than what the thing is worth, then we're going to say that you essentially own it. So we're going to do a similar entry in that we're still going to record cash going out and lease expense the same way that we would for a operating lease. The difference is we're also going to record an asset and a liability account. The asset is going to be whatever type of asset this is. So in this case, this example, we've got machinery worth $250,000. So we're gonna on our balance sheet we'll show that we own machinery of $250,000, but we also show on our balance sheet that we have a liability that's equal to that amount. So the asset and the liability, those cancel each other out, but we are showing that is something that we own. So that's kind of the difference. Okay, and then finally, again, these are some managerial accounting ratios that are looked at by stockholders and or investors. We've got debt to total assets ratio, which is pretty self-explanatory, and you get it by just having total debt divided by total assets, and that gives you the ratio. And then we also have times interest earned ratio. This is a ratio that investors or potential entities that may loan money, financial institutions, whatever, are going to look at to see how likely it is that you're going to be able to pay the interest that you owe on various items of debt or whatever you're paying interest on. So the way you figure this is you take whatever your income is before you pay income taxes and before you pay any of these interest expenses, okay? And then divide that by whatever your interest expense is for the year, okay? The reason that you take that before income taxes is whenever you pay interest expense, that's actually a deduction, so you don't want to factor income taxes into it because it's actually a tax benefit. Okay, so income before income taxes and before you pay any interest expense divided by whatever interest expense you're going to owe, and that gives you times interest earned, which is basically the amount of income or the number of times that you could pay with the income that you have all the interest that you're going to owe. If that's a very low number, then that's going to make debt holders very nervous because they know that interest isn't the only thing that you're going to want to pay. Okay, so if that's, let's say that's 1, then that means that if you're only going to be able to pay off all the interest that you owe if nothing else comes up. Okay, so that's going to make them very nervous. So obviously that would also make stockholders, potential stockholders, nervous as well.